Hello, chart watchers, and welcome to this Tuesday, June 11th, 2019 Market Watchers live show with your hosts, Tom Boley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Taking a look at the market action, we did have a nice gap up earlier, but those gains are eroding. We've got the Dow Jones Industrial Average currently up 19 points, the S&P 500 up 2, the Nasdaq up just a fraction now after being up probably about 80 points earlier today. The Russell 2000 down 5 3/4 points. 10-year Treasury yield is continuing to move higher, although we are off the earlier high of the day. Currently, we're up 1 basis point, 2.15%. Volatility index continuing to remain right around that 16 level, actually up a little bit today to 1635, up 2.5%. Leading the move to the upside, earlier leading the move to the upside, we had communication services, energy also having a strong day, financials, clinging to some gains. Banks, although they are off their earlier high, banks benefiting from this little bit of move here in the 10-year Treasury yield, making a move up to a high that we had not seen for almost a month. So banks will be interesting to watch if the 10-year Treasury yield can continue to climb. A couple of areas of the market that was in the news yesterday with the big merger, Raytheon and United Technologies yesterday had a big merger deal. And after we got the big gap up on the deal, you can see that there's been a lot of selling since then. I still like the defense group, but clearly after the announcement, we have seen selling in that area. I would be looking down here to this 430, 440 area where we saw a lot of buying coming in throughout May on any dips. Aerospace, however, on a relative basis has actually been more of an underperformer. You can see versus the highs that it had back at the end of April. Still quite a bit below that, where with defense, you can see we've actually moved higher. So the two have been going in opposite directions on a relative basis. Software stocks. Wrote about this in my blog this morning. I was a little concerned about that candlestick yesterday. Off of this big uptrend, that is a shooting star candle. We had a false breakout on an intraday basis. Gapped up today, but now we've got a pretty ugly bearish engulfing candle. Unless we see a big rally later today, I think short-term software could be under some selling pressure coming up. Caterpillar trying to advance for its 7th consecutive day. It is the leading stock, or at least it was about an hour ago, the leading stock in the Dow Jones. And then a company reporting earnings, Casey's General Stores, getting a huge lift after beating expectations and raising their dividend. Stock you can see up more than $14 today, over 10%. Big response to its earnings report. Okay, Erin, we missed you yesterday. How are you doing today?
I'm doing quite well. Spent part of my day at Disneyland yesterday in 97-degree heat.
Wow, that's hotter than the market.
Yes, I know. I'm surprised. It was interesting getting up this morning, though. I'm sure you were noticing it too, is the market was really flying this morning, and now, wow, really pulled back.
Yeah, and I didn't really point it out, but the Nasdaq, I mean, we actually had that big gap down back on May 13th on the Nasdaq from just above 7,900. And a week later, when we rallied back, we filled that gap around 7,900, and then we saw the selling take off in that latter half of May. Today's high was just above 7,900. So this is an area where we have seen some recent selling over the past 3 to 4 weeks. So I'm not shocked that we're reversing here. And when you've got one of the leaders like software, potentially showing a topping sign in the near term, I think that could be problematic here. So I wouldn't be surprised to see a little consolidation, maybe a little selling from this level.
Mm-hmm.
But we shall see. Anyhow, we do have a bunch of information for you today, including my workshop. I'm going to talk a little bit about relative strength. But Erin, why don't you get us going?
All right. Tim Ord is going to be with us on Wednesday of next week. Tim Ord will be here. I see I'm all discombobulated because I didn't come in yesterday. Tim Ord is going to be here tomorrow. John Murphy is going to be here Thursday, so mark your calendars. On Tuesday of next week, we have Danielle Shea coming in. She's our options expert. Greg Harmon is going to be on Wednesday, and then Mr. RRG, Julius DeKempenaar, will be joining us on Thursday of next week. Today's agenda, lots to cover. As Tom said, he's going to look at relative strength in his workshop. Aurora Cannabis, ACB, will be our first symbol in the 10 and 10. I will be covering breadth across the markets, and then we will finish with tops and bottoms at the end of the show. All right, Tom, technical news and headlines. Let's get it going.
All right. Well, we did have some inflation data out this morning. The May PPI came out right as expected, rose 0.1%. Core PPI also rose as expected, 0.2%. So really, no big shakes there as far as the bond market is concerned. Taking a look at the 10-year Treasury yield, you can see, as we mentioned a couple of days ago, this 2.04, 2.05% level holding so far and bouncing. Although today we are up less than 1 basis point now. And we were up probably closer to 3 basis points earlier today at the high. So we are starting to see money rotate a little bit back into those treasuries. So with treasury prices rising, we got the yield coming back down today. I would find it somewhat comforting if we could get through the 20-day moving average and hold. We really haven't seen that much since back in November. We've had a couple of false breakouts where we couldn't really, wouldn't stick. And then we simply rolled right back over. Notice that the 20-day moving average never went through the 50 as well, and that has been expanding and moving quite a bit lower than the 50-day here of late, I would say the last 3 to 4 weeks. So there's been a lot of downward pressure in yields, a lot of upward pressure in treasury prices, and that typically makes it a little bit more difficult for the stock market, although this past week or so we've seen a nice rally in equities when the bottom came in on the 10-year Treasury yield. So that'll be something to keep in mind and watch as we go forward. As far as earnings reports go, not a whole lot out. I think we do have some retailers going to be reporting later in the week. But last night after the bell, Casey's General Stores, CASY, reported. That was a really strong report, by the way, raising their dividend. Also, you can see on the bottom line, very, very nice beat. HD Supply Holdings beat on the bottom line, but not so great reaction in the market. And H&R Block, a little combination. They beat on the bottom line. They were straddling a key resistance level. So we're going to go ahead and take a look at those charts to get things started here. First up, Casey's General Stores. As far as make sure I got an update here. Got the latest. There we go. So right now we're up $14, $147. And this is following a lot of sideways consolidation. I think that's a nice bullish breakout. Volume certainly confirming we're not even the halfway point of the day, and already we've done almost 800,000 shares, which when you look back, there's only been a few days in the last year, maybe a handful of days where we've had more volume than we're seeing today in just the first, 3 hours or so. So really good day for Casey's General Stores. It's a group. It's industry group. You can see recently made a breakout, challenging 52-week highs. So on a relative basis, this is a group that's starting to see some nice inflows. And Casey's, you can see the huge jump in relative strength now with this earnings report. So this is certainly a stock I would keep on my watch list. Pullback anywhere close to the breakout level, upper 130s to around 140, I think would make some sense here from a reward to risk standpoint. HDS, this is HD Supply Holdings. Here was a breakdown. This looks like off of an uptrend. A left shoulder, neckline, head, right side of the neckline. It looks pretty symmetrical to me. We bounced up to the 20-day, failed, put in a bearish engulfing candle, and back down we came, and now we got the catalyst earnings to force this breakdown. So I would not be interested in this stock until we can get back close above 41 at a minimum, preferably back above that 20-day moving average. And this measurement here from 41 to 47 is $6. So we'd be looking at $35 to go back down here and challenge the lows that we saw to open 2019. That's what I think is probably more likely here with HDS. So I would steer clear. HRB, this is H&R Block. H&R Block, false breakout. Don't like that. And when you look at the group that it's in, it's been a very strong group. And yet on a relative basis, H&R Block has been one of the worst performers. You can see it actually hit a relative high versus its peers back in December. And now it's quite a bit lower, closer to the 52-week relative low than to the 52-week relative high. And that false breakdown bothers me. So until we could get a confirmed breakout above, say, 28.50, maybe 28.25 to 28.50, I would be a little leery here. I don't like, again, that false breakout and a relative weakness in the chart is not a good combination. Couple of other areas in the market let's talk about. First, the software space. And this was a problem coming into today, I thought. And actually, I pulled up my article from earlier, and here was the chart I was showing, software. And you can see hitting this resistance area, had the breakout yesterday on an intraday basis. Look at the volume, very strong volume, but we went back and closed near the low of the day. So that false breakout, shooting star off of an uptrend, to me suggested that we could have some problems. So I had just, I was wondering out loud in my article whether or not the bright green futures would enable software to get back up above that high and break out. But when we pull the chart up, you can see that essentially we went up, kind of tested yesterday's high, but now we've got a bearish engulfing candle. I wouldn't be surprised to see at least a move down to test this 20-day moving average, which would probably be another 2% to the downside in software. And if these moving averages fail, then what I would be looking for is sideways consolidation off of this move to the upside. So your highs just above 2,700. I think the low 2,450. This could be a more protracted sideways consolidation. I still would be very much in favor of this group. But if we fail to hold that breakout level and finish with this bearish engulfing and then go on to further struggle at those moving averages, I think that could set this group up for a little bit more short-term selling. Another area of the market to watch pretty closely, mobile telecommunications. The thing I wasn't overly excited about here, if we go to a weekly chart, I'm going to pull up the relative chart. Actually, I think that was also in my article today, so never mind. Let's go in and look at it here, and I won't have to annotate. Yeah, so here under Sector Industry Watch today, I was looking at the mobile telecommunications group, and I see a trend line. I see recent support down around 350. So I think if you lose the trend line 360 and price support at 350, that could be problematic for this group. And also on a relative basis, the group relative to the S&P 500 has this relative uptrend that essentially intersects with some pretty key relative support. So if we lose both this trend line in support along with the absolute price trend line in support, I think that would not bode well for this group going forward, something to keep an eye on. One stock I wanted to talk about quickly was Amazon. So let me pull Amazon up here. Amazon announced this morning that they were opening their second Amazon to go store. They opened one recently, and with the opening today, of course, we're trying to get through this 1900 level, reversing like we're seeing across a lot of the market. But it's been reported that Amazon could open as many as 3,000 stores by 2021. So I think this is kind of a landmark kind of thing, a little ironic, actually, because we were always concerned about the brick and mortar stores because of Amazon and what they do online. And now we've got Amazon thinking about opening 3,000 stores, physical locations, in just the next couple of years. So that'll be an interesting development to watch with Amazon. Okay, we are going to do the scooter mover of the day. And today's scooter mover of the day, I was looking earlier, MTN, looking at it on the list. Actually, I think it was the top. Yeah, I think maybe there it is. MTN. So it is the third, it's listed as the third biggest mover to the downside among the mid-cap stocks. And I wanted to bring this up because sometimes these movers to the downside could be breakdowns, but then they also could represent opportunities. And when I look at MTN, you can see right here, there's gap support, top of gap support. Here was the breakout. So I'm actually looking for maybe some support between 227 and 231, and we're sitting at 231 right now. So this is an area that I would be keeping an eye on and could turn out to be a profitable trade down the road. But I do think the top of that gap support is an area to keep a very close eye on. So that is your scooter mover of the day.
All right, I got you some upgrades and downgrades. I'm going to use our advanced charting platform so you can get a feel for it. I'm going to start off with Dollar Tree. JP Morgan upgraded it today from a neutral to an overweight. They have actually moved their target up to 122. So they're looking right about here, and you can see how nice that works out. You can see where you're going there. So 122 is where they're looking at for their new target. But when I look at the chart itself, clearly you have the overhead resistance right here at the all-time high, and we have a nice gap here that's just appeared, as you can see in there. So at this point, I would be looking for that 111, 112 area. We've got the PMO buy signal, so you like to see that. And OBV seems to be doing what you want it to do as well, with it rising right here. So that's what you want to see when you're on a move to the upside like we're seeing here right now on Dollar Tree. Next one up is going to be Facebook. I think people have heard of Facebook. It was actually upgraded today from a neutral to a buy, and they moved their target up here. Let's go ahead and get a horizontal to 210. So that's the overhead resistance right now. How does this line up? Well, you can see it doesn't even come up to the high we did see back in July of last year. So they're looking at that target. It looks pretty good at this point, and you can see that the PMO is beginning to turn up here. So I think that's a good sign as well when you see that movement on the PMO. Where is our current overhead resistance lying though for Facebook? We're up here at about 197. And you can see we just covered up that gap right in there on Facebook. So I do see more upside potential here. You've got the 20-day EMA turning up above the 50. And again, you've got that really nice looking PMO. And if we do a horizontal line right there, you can see that the OBV is starting to come above those previous tops. Want to see that kind of action as well. Next one up is going to be JetBlue. JetBlue is upgraded today by Citigroup from a neutral to a buy. They have their price target all the way up here at 26. All righty. So I'm not even going to get to that right now. There we are. So 26 right in here. That's where we're looking at. So I'm going to bring this back out and back where you can see it. So really they're talking about it challenging these highs that we see back up here. But let's get that right over there. We're still really far away though, as you can see from where we were there. Let me get this a little bit stretched out more. There we are. Look at the PMO. We just got a new buy signal on that. So I think that is something you do want to see as well. OBV, not participating quite the way I would like to, especially when you look at this movement here from these two tops. Watch that. So you've got moving up like this. But if you look at the OBV, it's moving mostly down to sideways. That tells you that the volume we're not getting that kind of we're not getting the kind of movement we'd want to see out of the OBV given the new top on here. So, all right, next up is going to be, let's see, we had Kimco. It was upgraded today, Kimco Realty, and I don't have a target on that one, but you can see right now challenging the highs that we have back here. Let's get that trend line here. Actually, I'm going to do a horizontal. There we go. So you can see we're challenging those highs that we saw back here on in April. And if we pull this back, let's look a little bit more into background here. And oops, sorry, getting a little crazy here. All right. So as you can see, currently the overhead resistance is challenging this top that we saw back here in 2017 around July. Again, it's really nice. You can see the labels down here. So you know where you're at exactly on these charts. I really love that about the features as far as this one. So you can see we've been in a little bit of a trading zone here for a while. Looks like we might be able to get that breakout, but again, this is the kind of thing you don't want to see. You've got OBV tops are declining, and we've got to see if we're going to get that breakout. We want the OBV to move up and beat out the previous top as well. And we're not seeing that. But when you look here, we've got a PMO buy signal that's just come in on Kimco Realty. All right, let's look at a couple of downgrades here. I'm going to start off with Symantec. It was downgraded today from an equal weight to an underweight. And they have taken their target from 23. So we'll get that horizontal. So $23. This was their original target. And now they have moved it down to 14. So now we're looking at all the way down here. So at this point, you know, that's a little bit worrisome. You've got the 50, it's just crossed below the 200. So I've got a long-term trend model sell signal. And you can see we'd already had the 20 move below that 50-day EMA back in the beginning of May. So we already knew there were problems brewing. And of course, you have this kind of a deep gap there. An attempt only got about halfway to close that gap, fell back down, set another low, was a little bit higher than the previous lows. So that's a good thing. But don't like seeing those declining tops. The resistance level that was hit that matches back here with the bottom we saw back in June of last year. So I don't think Symantec is not really lining up in the way that I would want to see it as far as the chart goes. We are getting ready to get a PMO buy signal, which is interesting coming off of that decline. Let me get this a little bit closer here. There we go. So we had just gotten the buy signal yesterday, and now it looks like with today's decline, we're probably going to whipsaw back. All right, the last one I'm going to look at is Wells Fargo. And let's look at overhead resistance. First of all, I do not have a target on this. But you can see right now the recent tops we were looking at back in mid-May. We managed to get back above it, but then we've fallen back below. And where is the support level? I would say it's right there at about 45.25 at the low that we saw back here in April. So that's where I would be looking at this point. That's all I have for upgrades and downgrades. We will be right back after this.
Okay, welcome back, everybody. Let's jump into my relative strength workshop. What I want to do today is just kind of share with you some of the things that I look at when I'm considering trading or investing in areas of the market. I always take a top-down approach. So the first thing I want to do is just get a sense of, do I believe the stock market overall is going higher or lower? There's a number of ways certainly to do that. One of which is just simply taking the S&P 500 and looking at it on a weekly chart and seeing if the PPO is positive or negative. Right now it's positive. If you're in a bear market, the S&P 500 weekly PPO is going to be negative. It can't be in a bear market with a positive PPO. Just can't happen. So I think the fact that we've got the S&P positive, we did have that trip in the fourth quarter of last year in the negative territory. We came right back out of it. The last two bear markets, we never went positive on the weekly PPO during the entire bear market. So I think when you can climb back, when you can get enough strength to get that weekly PPO on the S&P into positive territory, that normally is a pretty good sign that you are in a bull market. So I'm starting off with that premise that we are in a bull market. The next thing I want to do is to look to see which areas of the market I want to invest in. Well, I can tell you that with the dollar continuing to remain in an uptrend, and it's been in an uptrend for 8 years. Energy and materials, I'm really not going to spend too much time on those areas because they tend to underperform in a rising dollar environment. If the dollar is declining, then both of those groups can be leaders in a bull market. But when you've got a rising dollar, they tend to be laggards, and that's exactly what they've been for the last 8 years. So I don't want to spend a whole lot of time trying to find individual stocks in areas that are showing a history, and for good reason, showing a history that of underperformance. So here's the technology group, the XLK, relative to the S&P 500. So this is not telling us that technology is going higher. This chart down here on the bottom is telling us that. This is just the XLK. So the actual movements in the XLK. Up here, we're seeing relative movements in the XLK. So for instance, one of the problems back in September is you could see technology was moving higher and actually put in a new high at the end of September, but we are actually starting to roll over on a relative basis, which can be a warning sign. Doesn't necessarily have to be, but it can be. And if you notice at the bottom, when the group printed a new low, notice that we actually had a higher relative strength in technology. So in other words, technology was beginning to outperform the S&P 500, even though we were moving lower in the group and in the market overall. So that can be a positive sign. So it's always a good idea to at least take a look at the sectors, see what's working and what's not working. Hold on one second. Okay. So when I look at technology, I see a group, and when I look at these relative charts, there's a couple things. On a weekly relative chart, I like to see, my preference is to see price action, relative price action, above the 20-day moving average, above the 50-day moving average, and the relative PPO. Remember, this PPO is tracking the relative price action. So this is a relative PPO. You can have positive momentum in a group, but have negative relative momentum if that group is not going up as fast as the S&P 500. So what this PPO, this relative PPO, is telling us is whether or not the group on a relative basis has upward momentum. And so I like to see PPOs above the zero line. So I look at technology and I see a really nice looking formation. Consumer discretionary. I see basically the same thing. I mean, this is a group relative to the S&P 500 that's now been going up for about 19 months, ever since bottoming back in October of 2017. At these recent bottoms in the last 6 to 8 months, notice we've held the 50-day moving average. We bounced right back up. Throughout the entire period, where's that relative PPO been? Above zero. So it's telling you that it has maintained its relative momentum above zero. Now, there were periods when the relative momentum was declining, but you're still above zero. And I think that's really important. When you begin to go into a downtrending period of relative strength or weakness, what we'll normally see is a break below the 50, the 20 will cross below the 50, and you'll see that PPO, the weekly relative PPO, go negative. But when you're above zero, that is going to be an area I'm going to be interested in. So the XLY, I think, still looks pretty good. XLC, now this is one that I think is just kind of teetering and has been for the last 6 to 8 months. We had a really strong push in the summer of last year, really weak second half of 2018. And then since then, this year especially, just kind of choppy. Communication services really not doing a whole lot in terms of relative performance. A little bit of outperformance, a little bit of underperformance. And you can see the PPO below the center line first 3 months, 4 months of the year. And then we've been above it the last couple, but we're turning lower again. So when I look at this, this is a group that I'm still okay with, but it's not going to be a group I'm going to focus on because it's not showing me that money is rotating into the group on a consistent basis. And that's what I want to see. And by the way, that's exactly what these relative charts are showing us. The stock market is just a very simple case of demand versus supply. You have a limited number of shares, limited number of companies, limited number of sectors, industry groups, and just depends on how much money is coming in to drive these stocks and areas higher. And when you're seeing these relative charts moving up, it's telling you that more and more money is rotating into that group and less money is rotating into other groups in order to essentially finance this move to the upside. So you want to get into these areas that are showing consistent relative strength, like technology, like consumer discretionary. Industrials. Another one that, kind of has been on a little bit of a downtrend. In 2019, it looked like we were breaking out, PPO positive. Now we've gone negative. I think this is another group you can pick your spots, but for the most part, it's not really showing us that consistent leadership. Financials, same thing, although I am watching this downtrend. The 20 period is starting to rise and getting closer to that 50. You can see the price action squeezing here. I'd actually like to see a breakout here in the financial group. Now, there are areas in the financials that have been leading for quite a while, even though the overall group has been going down, and we'll talk about that in just a minute. Then we get into healthcare. Healthcare, now this is the exact opposite of what I was looking at with technology and consumer discretionary. You have the relative price below the 20-day, which is below the 50-day, and your relative PPO is below zero. So to me, trying to go into healthcare, you can pick your spots, and there's definitely some leadership emerging. And again, we'll get into the industries and look at that in a bit. But I think you want to be really careful because you have to recognize that overall, since November of last year, this has been a group that's been in relative decline. Consumer staples, another defensive area. It's above the center line. I want you to focus in on something, and I could go back to this prior chart on healthcare as well. The real strength that we see in the defensive groups generally comes when the market is struggling. So the fourth quarter of last year, we saw a huge breakout above prior highs. Healthcare took off on a relative basis. In May, starting in mid-April actually, but through the first half, maybe 2/3 of May, nice relative strength in healthcare during a period when the market was weak. Let me go back the other way. Let's take a look at the XLP, consumer staples. Look at the fourth quarter of last year. Relative strength picks up. April, May, when the market struggled, relative strength picks up. If the stock market goes higher, I believe you'll see these defensive sectors roll back over on a relative basis and move lower. They tend to lead to the upside when the market is weak. When the market is strong, like we saw throughout 2017 and into parts of 2018, you can see that's when consumer staples tended to be much weaker on a relative basis. So yes, I'm still okay with this area, but I do believe if the stock market goes higher, we're going to see what we saw on the rally coming out of December. We're going to see underperformance in this group. And I'm bullish. I think the market goes higher. So this is not a group I'm going to spend a whole lot of time looking at. Real estate, same thing. This, I think, is better than the other defensive groups. I do think that real estate is up for a couple of reasons. Number one, I think when the market gets weak like it did in the fourth quarter, money pours into the group. Same thing April and May. But also interest rates being so low, really helping this group as well. So if all of a sudden the market goes higher with the 10-year Treasury yield moving up, then I think we could probably see a period of relative decline for real estate. So a group that I'm okay with. I'll tell you what, if I was looking for if I was looking to diversify into some areas of safety like real estate, I would only look at the industry groups that are outperforming the S&P 500, and I would concentrate on stocks within those industry groups that are outperforming the S&P 500, all within the real estate space. So that's the way I would diversify if I were to diversify. I'm not a proponent of diversification. I think that as I wrote in my ChartWatchers newsletter article over the weekend, I think Warren Buffett stated it eloquently. I think that diversification is protection from ignorance. And he didn't mean it in a mean way, and I don't either. It's just that if you're not comfortable, you don't really understand the stock market, it's great to diversify just to be part of the market going higher. But if you follow the market and you're willing to put in a little bit of homework and learn a little bit, I think diversification just kills your portfolio. What is investing in energy and materials done for the last 8 years? Very little. All it's done is really hold your returns back. And the market's been telling us for 8 years not to invest in that area. So again, I think if you pay attention to these relative charts, it can make a big difference in your investing. Utilities, big move up in the fourth quarter, big move up April into May. Again, that's when the market was weak. Of course, you're going to see outperformance there. That's what I would expect. But when the market is strong, it goes the other direction. I would not be a fan of utilities. Energy, here we go. So here's your downtrend. We could pull this, let's go back. I know it's been 8 years, but we'll go back 10 years. And just look at the relative weakness in energy. If you're in a long-term portfolio and you're quote unquote diversifying by holding energy stocks, this is killing your portfolio. Has been for 8 years. Same thing goes for materials. This is only the 2-year chart, but you can get the same picture. It's just been a steady relative downtrend until that dollar breaks down, not weakens for a week or 2 weeks or a month, but I mean truly breaks that long-term uptrend line. I would not be looking at energy and materials. All right, that's the sectors. Now I'm going to go through some industry groups. And by the way, I've got 105 industries on this next chart list. And so actually, I think I've got it over here. So I'm not going to have time to go through all of these. I want to point out some of the individual groups, though, that I think look good, maybe a few that don't look so good. If you do have any interest in seeing all of these charts, I actually did a webinar last night at 4:30 with earnings beats. And I will just give you that area. If you go to their website, earningsbeats.com, relative strength webinar, click on it. You can go down here, sign up, and I believe John Hopkins, you can write to John at Invested Central. But John will send you a copy of the recording. It was about an hour and 45 minutes. Took quite a while. But anyway, I'm going to start off in this area with the technology stocks or technology industry groups. So this is the way I set up my chart list. So the first 7 charts are 001, just technology, XLK, and then I've just numbered 1 to 7 because there's 7 industry groups. And so I have a chart for each of those. Then I go into XLY, which is 002 for all of these XLY charts. And then I just break them down from 001 to 020. So there are 20 industry groups in that area. And then communication services and so on and so forth. So let's take a look at an industry group. Here is computer services. Computer services, well, I mean, it's looking like it's trying maybe to make a breakout here. But what I see is every time we get a little bit of strength, we just go back down again. So I don't have a whole lot of confidence here. PPO sitting near the center line. I think I'd have to see a more definitive breakout here in this group. So I would personally ignore this. Semiconductors. Now, this one is a tough one. And I say that because if we go back throughout this bull market, this is an area of the market. When it gets going, it can be just unbelievably strong. So when you look back to, say, 2015, middle part of 2015 until second quarter 2018, look at the relative strength here. So if you owned semiconductor stocks, and also actually it was probably right around here where the PPO goes positive, it stayed that way for 2 years. If you owned semiconductor stocks when they were outperforming the S&P 500, they would have held your portfolio up. They would have single-handedly helped you beat the S&P 500. When I look at it now, I see this recent high, and here's a pullback, which is steeper than these others. But you can see back at the beginning of the year, the group rallied, got back up above the 20-day, went positive, couldn't break out, and now has pulled back. But it also hasn't broken down. So we could have relative strength followed by relative consolidation. I'm not giving up on this group just yet. I would be very concerned, however, if you see this relative movement turn back down and take out the low that we saw at the end of 2018. That would bother me because then I'm starting to see more of a series of lower lows, lower highs. And when you see that, like here, this is when you want to be out of the semis. So right now, for the most part, I would be out. There are exceptions. I really like AMD. I think Applied Materials, I've been mentioning that one, showing a lot of relative strength. Lattice Semiconductor, LSCC. So there are pockets within the semiconductors that I would still be interested in because we haven't gotten a breakdown. But if we break down, I think those are stocks that you might want to consider exiting. All right, software. This has been an incredible group. And yeah, I know we're having a rough day today. We have rough days from time to time. We have rough weeks from time to time. But if every time we started to see a little bit of a pullback in software, if we decided, hey, it's been too much, we're going to get out, you could see the last 2 or 3 years, that would have been a big, big mistake. Talk about a group completely lifting your portfolio up. It's software. Last 3 or 4 years, this group has been straight up on a relative basis. And until it changes, look at this. We've had really since late 2013, there have only been a couple of brief periods where the PPO has gone negative. This weekly PPO has remained positive now for the last 3 years straight. So that tells me I want to continue to stay in until that strength is there no more. All right. See what else we have in this group. Telecom equipment. Beautiful chart. Just like I showed earlier on that sector chart, I think it was the XLY versus the S&P. Look at that test of the 50-day, test of the PPO center line, turn right back up. So in a group that's been outperforming, seeing it underperform for a period of time, sometimes not a bad thing. You can catch it right before a big move to the upside. But I think telecom equipment remains one of the strongest areas of technology. And look at it trying to break out relative to the S&P 500 again. All right, I'm going to go into consumer discretionary. Let me, restaurants have been very strong. Beautiful move up here in the fourth quarter when the market was weak, but we have exploded here over the past 3 to 4 months on a relative basis and on an absolute basis, setting new highs. So that's why I've had tried to have representation from this area in terms of individual stocks, because I think it's one of the strongest areas in the market. Now, groups to avoid: clothing and accessories. After moving up and being a strong area, look at the PPO. It was above zero for quite a while, but when it went negative here, which would have been back probably about the time it went below the 50-day moving average, from that point forward, this has not been where you've wanted to be. And you can see that PPO staying in negative territory. So I think as long as this downtrend persists, the 20-day stays below the 50, and we're in negative territory, I would avoid the group. Home improvement, mostly just sideways consolidation, not really seeing a whole lot here. See which other ones. Apparel retailers like clothing and accessories, you know, when they're above the 20 and the 20 is above the 50 and we're positive, that's when you want to consider owning stocks in the group. Right now, breaking to a 1-year relative low and in negative territory, very bearish configuration here. I think you're just trying to swim upstream if you jump into apparel retail. Not interested. Let me see. I thought there was one. Oh, footwear. So footwear is kind of an interesting group because I'm not quite sure what to do with this. Remember I said, pointed out that when you get back to the zero line, sometimes that's right before you make a big move to the upside. And here we are, footwear relative to the S&P. Its PPO is sitting right on the zero line. It did go a little bit below the 50-day, came back up, and is almost sitting on the 50-day right now. I'm not sure which way footwear goes here. I'm watching it because if it breaks back up above that 20 and you start to see the PPO turn up, I think that could be a sign that money is rotating back into footwear. All right, auto parts. Look at the relative weakness here. You want any part of that? I don't. That's 18 months of relative underperformance. It's going to be hard to make money in auto part stocks if the group is seeing money rotating away from it like that. All right. Industrials. I'm going to pull up defense because I know defense is having a really tough day today. You can see pulling back. But notice what it did here recently, and this was one of the things that got me interested in defense. Huge run up off of the April low, and you can see the PPO turn positive. Now we're having a rough day, rough week because of yesterday after the open and then today as well. But we're still above the 20 and the 50. I'm going to watch to see if we hold that. But one of the reasons I really like this group is that if we go back 10 years throughout the bull market, look how long this group can show relative strength. And here we are just breaking back in to positive territory. Now, that doesn't mean that it's absolutely going to stick, because I could point you back to 2010. We saw the same thing. Went above the 20 and the 50. The 20 comes up through the 50, and we rolled back over. So if we start to roll over again and we go negative on the PPO, then I would be a little bit more cautious. Railroads, they've struggled a little bit of late. But I think this is an opportunity here. I think railroads have been outperforming for quite some time. PPOs remained positive almost the entire last 3 years. One little blip here where we came right back up. So I think this is an area that continues to outperform the S&P 500 and is definitely a group that I would be looking for. I actually own a railroad, and it's because of the relative strength. All right. How about airlines? Look at the airline group. Just topped 2 years ago, and it's just been this steady move to the downside. Relative PPO below zero almost the entire period. Not looking very good there. And that's with crude oil prices dropping too, by the way. All right, financials. Financials, I showed you they haven't really been that strong, but look at financial administration stocks. They've been awesome versus the S&P 500. And this gets back to my whole relative strength versus diversification article that I wrote in ChartWatchers over the weekend. To me, relative strength is so much more important. Diversification means, okay, I want financial stocks. Let me just go get the XLF. Well, inside the XLF, you've got stocks like this, the financial administration stocks, but also within that group, you've got asset managers. Look at the relative performance of asset managers. So you're taking your relative strength, which is helping your portfolio out immensely, and you're combining it with asset managers, which gave you a sell signal 14 months ago. And yet you're just riding it because you're in the XLF. Great. I'm diversified. And this area of the market is killing my return. So again, I think if you're not willing to spend a lot of time looking at the market, or even a little bit of time, diversification makes sense. I would rather have somebody in the market and diversifying than not in the market at all. But if you're going to pay attention to the market, don't just diversify. I honestly believe that's what Wall Street wants you to do. Because while you're buying these asset manager stocks that are trending lower, guess what their market making units are doing? They're on the other side. They're gladly shorting. So I don't buy into that concept of diversification. I think that all it does is bring you back to mediocrity. All right, so that's pretty much what I wanted to go over. We're going to bring this poll up here in just a minute. We'll get a summary slide and then a poll. Let's see if there's one more chart first. Well, I will bring up in energy because I am a fan of renewable energy. So let's do this as a final chart. Here's renewable energy relative to the S&P 500, and you can see the huge outperformance in 2019. I mean, why wouldn't you want to be part of this? We went positive back in February, and so there's been 4 months of tremendous relative outperformance in this group. When it breaks down, you want to be careful because it can fall apart just as quickly as it rises. But this group's like semiconductors. When it gets moving, it can really lift your portfolio. And right now, renewable energy is very, very strong. All right, let's go ahead and summarize today's relative strength webinar. And essentially what I was showing you, I didn't really get too much into the stocks versus the S&P. I went into the industry versus S&P. But when I look at stocks, these are the three things that I focus on in terms of relative strength. And you see it on my charts here on MarketWatchers Live all the time and in my blogs. But I like to see how a stock is performing versus the S&P 500, how it's performing versus its peers, and how its peers, its industry group, is performing versus the S&P 500. Because if we're in a bull market and you're getting the best sectors relative to the S&P 500, and then you're in the best industry groups within those sectors and the best stocks within those industry groups, it's hard not to outperform the S&P 500. So let's go ahead and move on to the poll. I just wanted to see, when we talk about relative strength, I wanted to see how many of you actually look at some of the things that I talked about here and some of the things that I look at. Now, I actually put that first one, the one that's up there at 78%, I put that in there on purpose. And it's not a wrong answer. But I just want to say that that relative strength index does not tell you anything about how a security is performing relative to anything else. That relative strength is a little bit of a loose term in terms of relative strength, because all you're doing, it's a momentum oscillator that is telling you whether or not your security has momentum to the upside or downside. It's not telling you anything about how it's performing versus the S&P 500 or versus another stock or versus its peers, whatever. So I just threw that in there to see. I figured that was going to be the number one answer. But I'm actually, Erin, pretty happy about the high percentages on these other areas. I think it's really important.
Oh, absolutely. And I'm sure, having watched our show regularly, everybody's seen those relative charts. And we did have questions about where to get your relative strength charts, that chart style. And you use it a lot of times in the 10 and 10. So in our live chart list, you can just go to the articles tab and find the MarketWatchers live blog, and then go into the live chart list. And you can find the various charts Tom has annotated, and you almost always include a relative chart in there. And you can just copy the chart style.
Yeah, the other thing,
I'm going to give myself kudos because I did not choose the RSI.
There you go. Yeah, that was just a little bit of a curveball I threw in there. I do want to mention also, under the annotate button, there are a bunch of chart styles for various blog authors and analysts here at StockCharts. And so Erin has her predefined settings under there. So if you go down to just below the annotation link and it says chart styles, hit that drop down menu, and you can go down to my predefined settings, and you can pull up any chart using that relative chart list that you saw, or relative chart style that you saw.
All right. Well, we better get right into that 10 and 10. So I do have an RRG, but I'm going to go ahead and just have you go right in. We didn't have that many requests today, so there's a really good chance you're going to see your request come up. But the first one is ACB.
All right, ACB. I'm not a fan just yet. I marked a few things on this chart. Notice the top, higher highs, lower PPO, negative divergence, and then look at that bearish engulfing candle right at the top. So you got a big reversing candle with a negative divergence. You see what happens afterwards. Down at the bottom, you've got lower prices in terms of closes, but a higher PPO. And by the way, I'm drawing this line up here because the close on a hollow candle is up at this level, and I should have drawn it to the bottom of this red filled candle. But anyway, we had lower closes in play, higher PPO, and then that started the uptrend. So you can look for these types of reversals on the chart. But what I'm seeing right now is simply a PPO that just keeps going down with price action. And all of these red arrows are highlighting these failed attempts to get back through the 20-day moving average. And look back to November when we failed. Look what happened afterwards. We get up here, we fail, we go back down. So I'm not liking the way things are setting up right now in ACB. If we get back up through the 20, then maybe I'd be a little bit more interested. Until then, I'd pass.
All right. The most popular in the chat room. Looks like there is a tie, but Turtle Beach, HEAR here.
Yeah, this is one that just continues to drift lower and lower. I'm going to pull it up on my relative chart so that you can just kind of see on a relative basis. This stock actually topped on a relative basis versus its peers about 10 months ago. So it has just been on this steady decline, not just in terms of absolute strength, but also it's one of the worst performers in its group. So as far as annotating this, rather than looking at this price level or that price level, that downtrend and this relative downtrend versus its peers in the S&P 500 tells me just to steer clear. So I would pass on it.
All right. Next up, personal products, Coty, COTY.
All right. I think we could be topping here in the near term. I like all the volume coming in, but notice the volume has really slowed down quite a bit as we move back up into this 13.5, 14 area. You've got a nice chart, nice stock, relative strength looks pretty good. I just think you're hitting overhead resistance. Now, if we could get a move up above that 14 area, then I'd be liking a lot better, especially if the volume were to pick back up again. But until then, what we could see is simply a move up. This could be a cup and maybe a handle back to the 20-day moving average. So you might want to watch for that. The volume's been very light so far on this selling. But I think $13.50 to $14 is a sell area on COTY until we get that breakout.
All right. Next one, life insurance, Voya, VOYA.
Yeah, I know in the webinar last night I was looking at life insurance relative to the S&P. I didn't pull that one up today. But the group is starting to look pretty good. You can see here the strength the last 3 months, 2.5 months, life insurance relative to the S&P. And Voya has been a pretty good stock within this space. Also, volume trends have been pretty strong. Right now, I just think we're sideways consolidating. So I would simply draw my price resistance line there. And by the way, look at that top. That was a bearish engulfing candle at the top and a bullish engulfing candle at the bottom. So I think we're just in this range right now, 51 to 55.5.
Okay. Next one up, Johnson Controls, which is JCI.
Yeah, I think another one looks really good. There's been a lot of volume here. Red bars that might drive some folks away. I don't see any breakdowns. I don't really care about the volume unless it's confirming a breakdown. So I'm not seeing that here. I think the stock has been continually showing rising relative lows, starting to turn up again. So I like the stock. I think that maybe keep an eye on the recent low and that breakout level, which is the double top right around 40 to the downside, maybe that little tail down around 38. I think we just consolidate here and eventually we break back out to the upside.
Okay. Next one up is PEG, Public Service Enterprise, a utility.
All right, this one's going to be a little bit more conservative if you're a little nervous about the market, but I think this one looks good. Bearish engulfing candle a couple days ago with a false breakout. And you see what the stock's been doing since. I don't make this stuff up. I just see it all the time. Here you go. There was your breakout. It tried to make the breakout intraday off of an uptrend, came back down, and you see that bearish engulfing candle right there. That led to some additional weakness. So I think that the stock still looks pretty good. I just think we could potentially go down to the recent lows around 57. I just see sideways consolidation 57 to 61.
Next one up is on Semiconductor, ON.
All right. All right, semiconductors have been weak. This stock has been weak relative to the semiconductors. Even when the semiconductors were strong, this stock was relatively weak among its peers. Could never make this breakout and then fell apart. So I think there are a couple overhead levels that the stock's going to probably have some difficulties with. One is going to be getting back through about 2030. That was the prior low. We broke down. We tried to get through, failed, and now here we are again. Black candle, reversing candle. We had that false breakout right here. Volume could have been a little heavier. That was a little bit of a warning sign. But anyway, the breakdown here, I think until we can get back through, say, 20.5, and even 21 would be better. That would be gap resistance, the 50-day moving average. I think there are other semiconductors that I'd be more interested in. So I would avoid on for now.
All right. How about an ETF, the China Large Cap ETF, FXI?
All right, FXI, I do like to move back through that 20-day moving average. Let's get over here on a regular chart. FXI. Okay. Yeah, I mean, there's going to be overhead resistance. I actually like a lot of areas around the globe better than China, but I do like to move back through the 20. I would just simply say if you're getting in or if you are in, I want to make sure that 20 days that sticks, because this is a relatively weak performing part of the world. And if it can't hold its 20-day and starts to roll back over, I would be out. So this one would be a pretty simple one. I'd keep a pretty tight stop here.
All right, another ETF, the Consumer Discretionary ETF Ps Cd.
All right, that's the small cap. Yeah, I mean, part of the problem is the small caps. I mean, we look at the XLY, and you see movement above the moving averages, getting closer to those prior highs. When we pull up PSCD, you don't see that because the small caps have been so weak. That's been the big problem. So I do think you've got some overhead resistance. Small caps tend to perform better in June, but we are now getting, we're a third of the way through the month, and we haven't really seen that kick in just yet, not the relative strength anyway. But you can see the 20-day moving average and price resistance both coming in right at about that 58.5, 58.75 area. So I want to see that, see it get back through that level and start to see some relative outperformance by small caps. I think if we get both of those, then I think this could be a good investment.
All right, and our very last one will be L3 Technologies, so it's LLL.
Yeah, a lot of the defense stocks getting hit. I know this one was down 10 or 12 or $10, yeah, $11. First of all, it's getting a 20-day test, which if you go back throughout its history, they tend to be pretty good buys. So yes, it's going down. Yes, it's been pretty swift, but I'd actually be a buyer on the 20-day. I'm going to pull this up on a relative basis. I own this one, by the way. So this is a full disclosure here. On a relative basis, you can see here's the defense group moving up. Here's LLL relative to the defense group. So you have one of the best stocks. And here was defense relative to the S&P. Obviously having a rough couple of days here. But overall, I think still in an uptrend. So I would be looking for a 20-day test right here. So I'm going to put the little green arrow in. If it were to, and it's below the 20-day right now, but if it were to go trade intraday below, get back up above it by today's close, I think that would be a bullish sign. That's something I'll be watching.
All right, that does complete the 10 and 10. Here are the symbols that Tom just annotated. I will have those up in the MarketWatchers live chart list. Just go to the articles tab, click on the MarketWatchers live blog, and the link is right there at the top. We will be right back.
Market direction is the single most important thing all investors need to know. Get the advice you need by joining dozens of elite money managers and financial experts, including Steve Forbes, Paul Merriman, Tom McClellan, and Keith Fitzgerald at the Money Show Seattle June 15th and 16th. You'll hear real-time market analysis and learn which stocks, bonds, funds, and commodities you should buy and sell to build a safer, more profitable portfolio. Claim your free pass at seattlemoneyshow.com.
All right, it is time for our final market update. Markets were up to begin the morning, but we are now seeing prices in negative territory. Currently, the S&P 500 is down 0.16%, or just about 6.5 points. Nasdaq is also in the negative right now. It is down 0.26%, just about 0.25%. New York Stock Exchange just hit negative territory within the last 20 minutes. Russell 2000, we were talking about it. Small caps are certainly not participating in the same degree that we're seeing large caps. And you can see this right here. The Russell 2000 hit negative territory much sooner than our large cap indexes. It is currently down 0.6%. at this point, Canadian markets are still in the positive with the TSX up 0.16%. Treasury yields almost unchanged, reading currently 2.141%. The VIX is beginning to rise, but we are seeing it under a reading of 17, currently at 16.64. Dollar is unchanged, as is gold, no change. USO down slightly, 1 cent to $11.10, and TLT in a pretty much a consolidation range since yesterday, and might be challenging those highs. We'll have to see if we get a double bottom breakout here on TLT. And as far as our sectors go, energy is the leader, up just over 0.5%, followed by comm services and consumer staples. Big loser today would be the industrials, down over 1%, and utilities not far behind, down 0.85%. Back to you, Tom.
Okay, I'm going to take a look. I mentioned the Russell 2000 when I was talking about the small cap discretionary area, and the fact that that group has been lagging its larger cap counterparts on the XLY. I think this will help to explain a little bit about what's going on. The Russell 2000, when you look at June, you can see that we're bouncing. So if you're just looking at the Russell 2000 chart, you say, oh, okay, small caps are bouncing up nicely. The problem is when you compare them to the S&P 500, we are continuing to move lower, meaning that small caps are moving higher in June, but they're not moving higher at the same rate as the S&P 500. And that is sending the group down very close to a relative low that was established back in February of 2016, more than 3 years ago. So, and I've been talking for the past probably 30 days about the fact that historically the small caps tend to perform very well in the month of June, but they are performing well on an absolute basis, but they are not performing well on a relative basis, and that could be a problem as we go forward. We want to see money rotating into that area on a relative basis because they're more aggressive, and they're also companies that are that do almost all their business, if not all their business, in the U.S. So you have a better indication of our domestic economy by following the small cap stock. So anytime small caps are underperforming, it does give me reason to pause and to evaluate everything else going on in the market. So just wanted to point that out. But we are now going to move into one of our final two segments, breadth. And Erin, I know you have some interesting information on that, so go ahead.
All right. So what I figured I'd do is I'd go through the Decision Point Advanced Decline chart pack. I know we've been watching a lot of on the breadth, and as far as the participation, one of the nice things in our chart pack, the Decision Point Market Indicator chart pack, as you can see, I have all of these various groups of chart lists. And so I'm just going to go through the advanced decline ones. I'm going to start off with the New York Common Stock advanced declines. And what we want to look at, I'm watching a lot of these highs coming in. We've beaten out those May tops on a lot of indexes, particularly the large cap indexes. But what I'm watching is what's happening to the advanced decline lines and seeing if we're getting any confirmation for what we're seeing there, or if we are looking at some problems underneath the surface here. So we're looking at the New York Stock Exchange Composite right now. And as you can see, we have begun to make some higher highs, but breadth is not really following along. You've got, we did get a breakout from a declining trend, but like I said, I'm watching what happened at these tops versus what is happening at this top. And as you can see, we made a higher high, but we are not seeing those higher highs on the advanced decline line. And I think that's something that we should be concerned about. The NYSE all issues net advanced decline, same thing. We have a rising top here, higher highs from May, yet notice that we're not seeing quite the same action going on with the advanced decline lines. All right, next one I'm looking at is the Nasdaq. And in this case, we see declining tops. We haven't actually beaten out the May tops yet. So it's not quite as worrisome if we see the declining tops still, because that is going into what's actually going on the chart. But when I see a breakout, I really want to see the same kind of information coming out of the advanced decline lines. And right now, what I did notice is we are seeing, and this is a reverse divergence. We don't talk about these that often. Reverse divergence meaning I have rising tops, just barely rising tops on the advanced decline volume line. So this is telling me that we have the advancing volume starting to come up here, yet it has not been able to push price above the previous top. So that's a reverse divergence. We would expect to see, if we're getting higher highs on the volume indicator, we would want to see the same kind of price action with higher highs, and we're not seeing that. You can also see that as far as just the advances minus declines, well below the lows that we had seen before. Next one up is going to be the Nasdaq 100. And we are seeing declining tops still at this point on the Nasdaq 100, but we're getting the breadth participation here. We're getting higher highs now on the advanced decline. I think that that's a positive in this case as far as the breadth is concerned. And we're not seeing higher highs just yet on the volume, so it does look like we're getting that confirming action as far as the rally that's coming up. And what you will notice on a lot of the charts right now are the large caps, the OEX, the NASDAQ 100, they're performing far better than their smaller cap brethren. And we'll see a little bit more of that. So we're moving to the S&P 500. So we're seeing higher highs now, along with that higher price high. So we're seeing breadth confirming as far as that advanced decline line goes. But we're not quite seeing it yet on volume. We're still looking at some declining tops here, and we have rising tops going on as far as price is concerned. So we want to see that to confirm as well. But right now, it's not quite confirming because we don't have a higher high on the volume. In this case, it wouldn't have been a reverse divergence, okay, because we do have higher highs coming in. So if we have a higher high on volume, that's a confirmation that that higher volume is pushing price up the way it should. So hopefully that makes it a little more clear as far as those divergences. All right, S&P 100, again, rising tops right now. You can see that breadth is confirming. We're seeing higher highs. Not quite seeing the same thing going on here with volume, and I would look at that as more of a negative divergence. Declining tops versus rising tops on price, not what you want to see. You want to see it confirming. If you're getting higher highs, you want to see higher highs on volume. So that's where I'm having some issue right now. We are getting very overbought. I've been looking for a buying exhaustion based on breadth and on the VIX. I'll show you that chart real quick before I move on. But here we go. Here is the Dow Jones, and you can see the higher highs. We're getting the confirmation right here from the AD line. But, and it looks like we're just about ready to confirm on that volume. You can see it's just starting to push just above that previous high. So in the case of the Dow, we're seeing some confirmation on the rise that we've got. All right, S&P 400. Now this is where you're going to see some differences. Declining tops still, declining tops on the AD lines. That's expected. You can see there is quite a bit of margin. This is the margin that bothers me, is you have from those previous tops back in May, and you're looking at breadth now, and the margins are getting pretty big between that. You want to see, again, you need to see volume moving in the same direction nicely, tightly. Declining tops right now on the volume and on the AD lines. So that is confirming a decline coming. All right, and we have the last chart, which is the S&P 600. Look at the declining tops here. I mean, clearly the small caps have just not been participating in the rallies that we have seen. Look at the difference in the AD line here. Look at the margin. We do have the declining tops, still declining tops on the AD lines and on volume. The main thing is that margin. We're just not, the participation isn't there. We're getting those pushes higher, you know, with the rest of the market, but it's just Russell 2000, I'm looking at it right now, and it's down over 0.5%, versus the S&P 500, which is only down 0.2%. So a lot of weakness here in small caps. If we really want to see a rally to those all-time highs, we need to see the small caps starting to participate, and we just simply aren't. All right. I think it's time we will go ahead and move on to our next segment. There is the summary for breadth. I went over those advanced minus decline lines, and then we looked at the advancing minus declining volume. I think it's important to look at both of those together, not just an AD line. All right, but it is time now. I'm going to find some tops and bottoms. Are you ready for that, Tom?
I am ready.
All right, I'm going to get my screen it's being weird right now, so I want to get that.
I'm anxious to see what you came up with.
Well, here's what I decided to do. So I ran my scans like I always do, but I just wasn't seeing what I wanted to see. I wasn't seeing some of these moves on the early side, because when we're looking at tops and bottoms, we're really looking at where is that reversal? Is it starting to happen? Are we at a bottom? Or are we at a top? And I found when I was just looking through our predefined scans, and let me show you how you get to that, because you'll want to know. If you go onto your dashboard, you can go, I usually scroll down here to the scan section, and there you go, predefined scans. Or if you go up here to charts and tools, it's going to be on the side here for your the advanced scan workbench and predefined scans right there. So the one that I decided to look at was the oversold with improving RSI for the bottoms, and then overbought with a declining RSI. So I just pulled up a few of those charts, and I'm going to show you right now what I have. So looking at those 11 in the Nasdaq, and I'm going to move these into my lovely scan dump, my transient chart list, so that I can now manipulate them and look at it in candle glance, because that's what I always do. So now this is great, right? So I'm actually getting the stocks where you can see these bottoms starting to form. And not only that, notice that the PMO is pretty much going in line with that. Now you can see with this one, we're not getting that same confirmation from the PMO. So despite it having an improving RSI and being oversold, this one I wouldn't be looking at, because it's just not, it doesn't have the characteristics I want to see in a market or a stock's bottom. But look at these. There's some really great ones. It looks like Baidu might be coming up to challenge the gap that we saw earlier around that 125, 130 area. The PMO is finally turning up in a nice way. We got a breakout from a declining tops trend line. So there's a great one as far as bottoms go. And then I was looking also at Century Aluminum was another one. PMO is turning up nicely, very slowly. I like to see that. And if we can get a really nice clean crossover, I think this one is lining up pretty well here, and that's in the materials section. Hasn't been the best performer from April to June, but it does look like it's getting ready to form a bottom. And at the low price of $5.81, your overhead resistance is up here at about $6.50. So you still could pull something off here, even though overall this hasn't been the best performer out there. So the other one I was going to look at as far as our scans go was down in here, and that's overbought with a declining RSI. We'll look at some from the NYSE, and again, I'm going to replace that scan dump. That's my transient chart list. I put everything in there from my scans, and I know that I'm going to rewrite over it. So if anything's interesting, I have to save it to another chart list. But Let's go ahead and look at this in candle glance. So now we're looking at topping formations. And again, you've got the PMO that's starting to turn down and really give you that sense that we might be looking at a reversal point at a top. So Fortis, let's see, these still have rising PMOs, but they're getting into that overbought territory. So you could maybe take a look here. For example, there we go, Fortis, FTS. You've got the top is already starting to form. We're seeing a drop below that 5-day EMA. The PMO is still rising, but it is starting to turn over. So that might be one, if I were holding it, I would want to take a peek and watch to see if we can keep a support level about 38. But the fact that it does look like it's starting to top, we know based on it being in that scan that we're also looking at an RSI that is on the decline. So this is your warning. You can look for a top, and I would want to watch support just above 38. But I would expect if we continue lower that this could be a little bit more of a significant top. Let's see, what is another one that's going to just pique my interest here? Let's see, Schwab. This is a different one, the short-term treasury. I don't want to look at treasuries. I like this one here, WRB, Berkeley. This is property casualty insurance, and you can see the PMO has peaked. It is twitching. It is pointing downward now based on the move that we're seeing. But we are getting action now below that 5-day EMA. You've got support right around here, just above 62. I think that looks pretty good. That might be the place to start watching. But when I start to see it turning, if I'm in a short-term investment and I'm starting to see the deceleration going on in the PMO, I don't want to see that. I really don't. All right, Tom, what do you have as far as our tops and bottoms?
All right, well, I focused exclusively on tops today because I think the market is at an interesting level where it could be topping. Mm-hmm. So first, before I get into individual stocks, I want to just show this chart of the Nasdaq. I referenced this earlier in the show, but when I take a look at where we got to today and just draw this line across here, I mean, you can see that this is where we had gapped down, by the way, back on May 13th. We had closed just over 7,900. We gapped down. Here we move back up. We pull back, move all the way back up. Normally what would happen in a downtrending market is we would see this pullback here, test the 20, fail, move to a new low, come up, test the 20 and fail. And the reason I say that is because with these two lows, you can see the PPO is continuing to accelerate to the downside. So normally you just get little oversold bounces. And a lot of times you won't see an actual move back up past the 20 and to the 50 until we get a positive divergence to develop. Well, in this case, we actually went through the 20. So I think that's a bullish deal. And now what I'm looking for is a continuation type of a pattern. So I think what's going to happen off of this uptrend, I think we established an inverse left shoulder. Right here is the neckline, the inverse head. Here's the right side of the neckline. I think we pull back one time, maybe to the 20-day moving average. If it's symmetrical, maybe we get back to 76.50 or so. But I think it could be just the 7,700 level, and then I'd be looking for a breakout. So I'm going to look at just tops because I think short term, the action yesterday and plus what we're seeing today just suggests to me that in the very near term, I'm just talking about next day or two, I wouldn't be surprised if we were down a little bit. So I went with some individual stocks that I think could be topping. The first one was Cisco. So when I look at Cisco here, what I see is a stock that hit the high that we saw all the way back in April, and so far not getting through. Volume is pretty decent today, not huge, but decent. So I'm going to see where we finish. But if we have a breakout on an intraday basis and we fail and we go back down to the low of the day or close to the low of the day, that's going to be a shooting star candle off of this uptrend at resistance. So I think Cisco could be putting in a short-term top. Now, if we rally this afternoon and get back to the high and break out, then all this is for naught. But that is just something that I'm thinking we might see is just a quick pull back, maybe to the 20-day, maybe back to this 55 area. But then I suspect we're going to go higher in the market, and I think Cisco goes higher. Next up is a small stock. I had never heard of it, so I'm thinking probably many of you have never heard of it either. CFMS, Conformis. A lot of volume coming in on this stock, and it's been trending higher. But I don't like when I see a big reversal on heavy volume. Check this out over here. Uptrend, big red candle, heavy volume. We could never get back through that level before we consolidated for quite a while. Then we make another breakout, another extended move to the upside. Look at that big red candle on good volume, sideways to down for a while. Now we got another big move, and today looks like it could be another one of these types of candles. This one looks like it's getting a little toppy. I like the chart, though. I like the volume trends. I just think this is one that could be reversing. FISV, I think this was a 10 in 10 stock from yesterday. Said I didn't like it. Well, I would be a seller up at this 90, 91 area because we've got overhead resistance. We just need to respect it. Today, we're getting that bearish engulfing candle. I think that confirms that. LSCC, Lattice Semiconductor, making a move up. We actually took out this May 1st high on an intraday basis, but we've got this black candle now off of an uptrend and with a false breakout at this point. So unless we strengthen late in the day, I suspect we're probably putting in a short-term top here on LSCC. INFO, just two more here. I think you can kind of see what's happening here. Bearish engulfing candle. I think the PPO looks good, though. So I'm only looking for maybe a trip back down to test that 20-day moving average. But I think this kind of looks like what we saw maybe back here in early March, where we bounced off the 20-day, put in a dark cloud cover, and then went down for 4 or 5 days. I think we could see that kind of drift back to the downside. And then the last one is Dunkin' Donuts. I think Dunkin' still looks pretty good, but I'm concerned about a possible shooting star off of this uptrend. So if we continue to weaken into the close, I think we may be putting in a top here on DNKN. All right, and that's what I had. So I just focused on the tops based on the fact that the Nasdaq looks like it has gotten to a really key area of short-term resistance. So this is just where I would expect maybe the market would take a little bit of a pause, see a little profit taking in some of these stocks, especially most of those stocks I showed you. I actually think they're pretty bullish looking charts. I just think they're a little overdone, a little overbought, and probably just need a little pullback. All right, well, we have a couple minutes left here. I thought maybe what we could do is just go over what's going on in the market. We are seeing a little bit of redness in our major indices. And once again today, we're seeing that relative weakness in small caps. You pointed it out, Erin. I pointed it out. It's something that's been, I think, plaguing the market for quite a while. I think it would help the market if small caps would start to lead. But we really haven't seen that. We're not seeing it today for sure.
No, it's definitely been the large caps that, are performing relatively better than those small caps. And, I think looking at the breadth charts that I looked at as well, I think everything is really confirming the fact that there is that weakness in the small and mid caps, actually. And typically, when we want to see those rallies up to all-time highs and that kind of thing, you really need to see those small caps getting on board. You need that wide participation.
Yeah, and they're going up, but they're just not going up fast. So they are participating in an advance, but they're just not doing it on a relative basis. And that's problematic. I think when you go back and you look at some of the better moves in the market, typically what we see is the Nasdaq and the Russell 2000 both leading the S&P 500. Nasdaq's been doing okay during this rally. The Russell has not, though, and that's, that was that chart I showed. It's bounced in June, but the relative strength's been down almost every single day in June. And
right.
That's the problem.
I know that Carl was looking at new highs because we've been getting these really high readings on the S&P 500. But if you look at the new high charts on the other indexes, not the same.
Yep. All right. Well, you can see I just pulled up here the top 10 down stocks on the Dow, with the Dow moving in the negative territory. And you can see it's really being weighted down by a couple of these aerospace stocks. United Technologies, of course, with their deal with Raytheon yesterday, and now Boeing also down 1.15%. But anyhow, it is a wrap for today. I do want to thank all of you for being with us today. Please remember to complete the survey as you exit. I'd love to hear what you thought of the relative strength workshop today. As a quick reminder, Market Watchers live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody, and we'll see you back here tomorrow. Happy trading.